There are exceptions to this general rule that, when correctly applied, permit the gifting of assets as a means of spending down. So, spending down countable assets on paper to the required limitation is possible using a combination of the general rules and their exceptions. Approximately 60% of the countable assets are gifted to a trusted person. This uncompensated transfer is penalized under the rules. The penalty is simply expressed as a waiting period during which the applicant must self-pay for care. The remaining 40% of assets are used to pay for care during the waiting period. When the waiting period expires, Medicaid will begin to pay for care. The gifted assets become protected and are available for the trusted person to use for the benefit of the disabled person. Now, the key to this spend down strategy is to understand what event triggers the waiting period. It is triggered by filing the application and receiving a written provisional approval. This is simply a letter from Medicaid stating that the application is approved, but Medicaid payments will not start until a future date because assets were gifted as part of the spend down process. The length of the waiting period is based on the total gifts made in the 5 years leading up to the application date divided by $12,000.